Welcome to the Explainer. When a brand new crypto asset hits the market, the surface level metrics are completely designed to draw you in. It's all glossy marketing. But as we always like to say, the real story, it lives in the code. Today we're going to take a structured look at a token called apxUSD. We're going to peel back those layers to see what it promises on the surface versus what its underlying architecture actually delivers. To hook you right out of the gate, consider this score, 5.0 out of 5.0. Now, your first instinct is probably to think that's a perfect score for reliability. Actually, scratch that, it's exactly the opposite. This is a maximum high-risk score. And we found it buried deep inside a Yearn GitHub risk assessment for what otherwise looks like a shiny, perfect new stablecoin. So how does a token that looks so pristine earn a maximum risk warning from technical auditors? Well, that's exactly what we're going to uncover today. Section 1, the allure of apxUSD. Let's dive right in and see exactly why retail traders are flocking to this new asset. If you pull up the high-level data from platforms like RSI Hunter and MXC, apxUSD looks absolutely rock solid. I mean, it's sitting perfectly near its $1 peg at 99.99 cents. It boasts a remarkably healthy market cap of nearly $277 million, with a really solid volume to market cap ratio of roughly 5%. For anyone out there screening the market for a safe haven to park their capital, these metrics literally scream stability and liquidity. Honestly, it looks like a textbook success story. Now, the engine driving that massive market cap is their dual token model. The protocol markets itself as the first dividend-backed stablecoin. So, here's how the whole shebang works. They use off-chain preferred equity from publicly traded companies to back the token. You hold apxUSD as your stable synthetic dollar to use for liquidity. But if you want yield, you take that apxUSD and lock it into an ERC 4626 vault. In return, you receive apyUSD, which is designed to actually increase in value as dividends are paid out. It's a highly attractive narrative, right? It's engineered perfectly to draw in yield-hungry investors who want the safety of a stablecoin mixed with the real returns of real-world assets.
Section 2, Retail Traders and Emotional Traps.
Before we even look at the actual smart contract code powering this system, we really need to understand the psychology here. Why do our brains want so desperately to buy into this polished narrative? Trading educator Tyler Stokes has a great perspective on this. He points out that, losses are just part of the game. Think of them as tuition. Mistakes are totally normal for everyday traders. But here's the critical part to remember. Institutional whales actually count on our emotional predictability to create liquidity for their own massive trades. When we see a shiny new narrative, like a dividend-backed stablecoin with perfect top-line numbers, our emotions tend to just completely override our critical thinking. Stokes outlines the top emotional traps that retail investors fall into. We chase breakouts right into traps. We overtrade out of pure boredom, we buy high out of FOMO, and we end up abandoning our trading strategies. But the crucial point to focus on here is ignoring risk management. Ignoring the technical risk of an asset simply because the marketing looks good is the ultimate psychological trap, and it's the one that complex tokens exploit the most. We get mesmerized by the yield, we look at the market cap, and we just stop asking the hard questions about what actually secures the asset.
Section 3, Under the Hood, High Risk.
Now, what's really interesting about this is how the actual code acts as a stark reality check against those emotional trading habits. Remember that 5.0 out of 5.0 high-risk score from the Yearn assessment we just talked about? Well, this is the primary reason why. The auditors explicitly failed apxUSD's critical risk gate because it relies entirely on unverifiable reserves. The real-world assets that are supposedly backing this token, they live entirely off-chain. There is zero on-chain proof of these reserves. And to make matters worse, the protocol promised monthly attestations from a registered audit firm, but at the time of the risk report, which was 36 days after launch, absolutely zero attestations have been published. You are essentially operating on 100% blind trust.
Furthermore, we have to look at the massive liquidity mismatch developing here. The total supply of apxUSD just ballooned to nearly 67 million tokens in a little over a month, and over 55% of that supply is locked up chasing yield in the apyUSD vault. But look at the curve pool, which is the primary decentralized exit ramp for this token. It holds a measly 4.1% of the supply. In fact, while the overall token supply exploded by over 400%, the safe liquidity in that curve pool actually dropped. It went from $9 million down to just $5.5 million. Think about that. If everyone tries to exit that vault at the exact same time, the decentralized liquidity simply isn't there to support them. But perhaps the most alarming detail of all is the protocol's centralization and admin control.
The entire system is controlled by a 3 of 6 Gnosis-safe multisig wallet. That means just 3 people need to agree to make sweeping, fundamental changes. And what's absolutely terrifying is the execution delay. It's 0 seconds. None. There is no time lock whatsoever. These 3 admins can upgrade core contracts instantly. Because of this 0-second delay, they can theoretically bypass all minting safeguards and just print completely unbacked tokens in a flash. So you aren't just trusting the off-chain collateral, you are completely trusting that these 3 specific signatures will never be compromised or act maliciously.
Section 4. The threat of smart contract exploits. Let's move to a cautionary tale to see exactly why centralized control and smart contract flaws matter so much. We're going to look at a CertiK incident report on a completely different token, an exchange token called Apollo X. This really illustrates the visceral, high-stakes consequences of protocol security failures and why we absolutely have to care about the underlying code. Because when things go wrong in crypto, they do not happen slowly.
This timeline is a terrifying reminder of how fast disaster strikes. In minute 1, an attacker exploited a centralized signature verification flaw. This was a vulnerability living just outside the audited smart contract code. By minute 2, they withdrew 53 million tokens. By minute 3, they dumped those tokens on PancakeSwap for $2.1 million in stablecoins. And by minute 4, the token's price had collapsed by over 52%. 4 minutes. That is literally all it took for retail investors to lose massive amounts of wealth because of a technical failure in the protocol's design. When a system lacks proper time locks and decentralized safeguards, kind of like what we just saw with apxUSD, this is the exact speed at which a catastrophic failure can happen.
Section 5. Managing your crypto risk. So what does this all mean and how do we navigate it? To protect yourself from these hidden technical vulnerabilities, we really have to return to Tyler Stokes' practical framework for avoiding those emotional traps. Step 1 is writing a strict trading plan and actually sticking to it. Step 2 is fighting the urge to overtrade just because you see a token printing green candles or boasting a massive market cap. But Step 3 is your ultimate shield. Manage your risk by allocating only 1 to 3% of your portfolio per trade. When you strictly limit your exposure like that, even if a protocol you've invested in suffers a 4-minute fatal exploit or prints unbacked tokens through a centralized multisig, your overall portfolio survives. Strong risk management is absolutely your best defense against these technical unknowns. Which brings us to our final thought for this explainer. The next time you see a token with a beautiful website, promises of high yield, and a rock-solid market cap, I want you to ask yourself this. Are you trading on solid technical conviction, having actually looked at the audits in the code? Or are you just blindly hoping that the off-chain vault isn't empty and the admins don't get hacked? Don't let the glossy marketing override your risk management. Do your due diligence, verify the code, and trade safe. Thanks so much for joining us for this explainer, and we'll catch you on the next one.